Writing an angel check is easy. Knowing why is the flex. Angel investing. Underused, misunderstood, explained badly. Angels Decoded, an educated and raw take. In cahoots with Play Money.
Hello and welcome back to Angels Decoded. As we move through the fundraising process, we learn about acronyms, and today we're dropping another one in, and that's called a safe note. A safe note is not necessarily have much to do with safe. It stands for something. Cheryl Kellond, welcome to the show. We're talking about safe notes. I would say that they're fast, but they're fuzzy. Tell us a bit more about safe notes.
So you're buying into a company now. It's not actually equity, but it's a promise of future equity for that. I love the take that safe notes can be fuzzy. I sometimes say safe notes are not always that safe. A few months ago, I was in line at the drive-thru with another founder, getting some Chick-fil-A, and we were talking about our raises and our capitalization. He told me he had raised $6 million on safes over 6 years at many different post-money valuation caps. And I took a little gasp, and I asked him how much of his company he owned after those safes, and he couldn't tell me. I knew one of the fund managers that invested on one of those safes. She couldn't tell me either. And that scares me. And I think that goes right to the core of they can be fuzzy.
Yeah, the reason that people use a safe note, which is the simple agreement for future equity.
Thank you. That was our simple agreement. I was like, oh my gosh, I blinked out in the morning.
Yeah, it's the most simple thing in the world that you could do from an investment standpoint. And there's a template that people quote, and the one that a lot of people use comes out of YC, and it's fairly standardized, but people get a little confused by it. But the reason it's in place is that when you're an early stage company and you're having angel investments, is the valuation is almost impossible to state, right? Like knowing what you're worth and doing a price round where you're getting a specific calculation, it's complex in that early stage.
You know what? I'm going to call a little BS on that, actually. Here's because I don't buy that. So the reason, first of all, safe notes are the best things ever invented for founders because they're super simple. There's no legal work done on them. They're widely accepted. And most importantly, you can close money asynchronously. If you do a traditional priced equity round, you have to have all your investors lined up at once, ready to close at once. The situation you're in at early stage is like you're going to take some money here, you're going to take some money a few months from now. You don't have both the time or the traction to pull yourself completely out of building your business and do a coordinated fundraising round. Being able to take money sequentially as you go is the most productive thing for the business. On the valuation part, here's what to understand on safes. Most safes now there's a post-money valuation on the safe. And what it means is it makes it really simple for you to figure out as an investor how much you own. You take the post-money valuation, you divide it by the money you invested in, and that's your percent ownership. So if you have a 10 million post-money valuation, you write $1 million check in, you own 10%. Folks say, oh, we like doing safes because we don't have to set a valuation. Technically, you're not setting a valuation, but you're sending an awfully strong signal. That post-money cap on the safe, post-money cap on the safe, acts a little bit like a valuation. Now, in the future, when that safe converts to equity as a price round, how that cap really works is you get the lesser of that cap or the value of a priced round. So yeah, technically the cap on the safe isn't a valuation because if you raise a priced round later at a lower amount, the cap didn't hold. The investors on the safe get that lower amount and the protection of that. But the cap on a safe is a really strong signal of where you think your company is at. And I would say a little sanity check on the founder.
Interesting. And let's start with some foundation parts of that process. So from the founder side, I think it's important for angel investors to understand that the way that a founder looks at this, they're getting different signals and information to help price their business. And if they're pre-revenue and they don't have any runway, like defining that is hard. Can you just give us a bit of a snapshot to help angel investors understand from a valuation perspective, what are some of the ways that a founder would go through that just to give investors peace of mind that they're not just pulling some random number from the sky?
What if I think we're all pulling a random number from the sky? I mean,
Well, talk
seriously,
me through
we
that.
are, right? Like we are. We're sort of pulling it out of our asses based on what other people are doing. So if you're pre-revenue and pre-product, if you're not in California as a multi-time exited founder, you're going to set your post-money valuation on your safe at like 5 million, 8 million. If you've got a little more traction, you'll set it up at, 10 to 12. If you're in Silicon Valley, you're going to set that thing or 20 or 30 million dollars. Like it's just, we are all sort of making it up. As someone who sees a lot of deals, I do use it as a gauge of founder sanity. I saw a company the other day. They had domain expertise in the area, but they hadn't shipped anything, not a single thing. And they've been working on it for a year and they're doing their first fundraise. So no traction, no product out there, no customer feedback, no revenue. And they had a 15 million post-money valuation on it. And my take to the deal lead on the deal was, I'm worried about this. I think angels will sign up for it and be okay, partially because you get the lower of that number and what it converts at, but mostly because most angels won't know what they should be looking for. But they wanted to raise like $2 million. They were going to need some kind of anchor fund investing in their deal. And I was like, pre-seed stage fund, I'm not convinced a pre-seed stage fund is going to wrap their arms around that number. If the company is setting itself up with the thought in their mind that they should be getting that, it might slow down their fundraise. And then all of a sudden, they're spending more time trying to get money than they are actually getting a product out there and getting signal. So that's a little bit of the frame I view it as.
And if you're an angel investor and you're looking at that, there's a couple of things to understand. And quite often in that early stage, founders will feel like they need capital. And if they're building something that has a large investment requirement, say it just could be AWS credits, it could be a physical product. There's things sometimes you just need capital on to be able to get momentum, and that can help. But what it typically means though is they will define an amount, 500,000, $1 million, and they typically, if they're half buttoned up, then they'll have some kind of plan on how they intend to spend that money and what it looks like afterwards as far as where it gets them to. And the reason why that is interesting is if they want to raise $1 million at a 10 million post and they're prepared to give away 10%, quite often that reverse engineering model is that they want to raise $1 million, they're prepared to give away 10% of their company just at a philosophical level. So they do a post-money valuation at 10, so the math all stacks up. I've seen that happen in that stage as well.
It's all reverse justification of math, right? Or it's expect to sell 20% of your company at every round. It's totally math backwards. There are some benchmarks you can look at in the market, but it varies so widely that we're just all making it up-ish.
And there's some public data you could get in category and stage of business, particularly if someone's gone on to Series A and they've had more formal raises through a VC fund. A lot of that historical data as far as valuations and fundraising becomes public as well. So you start to see some of that information. So you can get some patterns around it. But again, it's a lot of finger in the air. The second part I'd love to be able to talk about, and you covered it there, which is advantageous for a founder, which is the rolling nature of a safe note as well. So if you do a price round and you go through VCs, you typically need to get to a certain point from a fundraising perspective to say that that round is closed and you actually receive all of that capital. So it takes a long time to actually get a dollar, let alone the whole thing, and you're tied to what that looks like. Can you tell us about the rolling capital nature of a safe note and why that's advantageous for a founder?
You bet. So my company Played Money raised our friends and family angel early pre-seed money on a safe. We raised it over the period of a year. I'm going to tell you what we did and tell you why it made sense. We had an anchor investor when we first started, a VC fund. We incubated our company there and they gave us a chunk of capital on that safe note. And then over the next year, we ended up raising more money actually 60% of the total money we took in from customers on our platform on that same safe. What the safe allowed us to do was take money incrementally as we needed it and as we knew what we were going to do with it, but always be building in the business. For us, it was unique because we had a group of customers on the platform. They would come on, they were new, they'd love what they saw, they would go on to invest in us. So we had a natural flow of money coming in, but this allowed us to get the capital we needed to keep building without making it a one-time stop building event. What we were able to provide to the angels that invested on this safe note, so we took money in every few weeks, every month, as people would come onto the platform and want to invest. We were able to show them that we had an anchor investor that came in. So we, from day one, knew we had enough money to run a set of experiments to get to the next learning milestone. So it wasn't like an investor was coming in and just dumping money into a void. Because while it's really advantageous for a founder to be able to raise little bits as they go and maybe take it from friends and family first, maybe take it from second, what you always want to make sure is when a founder's raising like that your money is going to help them get to whatever that next learning milestone is. So most angels won't go to a founder that they don't personally know and say, hey, cool, I'm going to be your first $5,000 in. Because guess what? $5,000 doesn't get you very far. And you want to make sure if I give you this money now, you can make progress with it. That's easy to do once you've got some momentum rolling, but in the early stages, you got to know where it's going to get them. But the rolling nature, it's what we all need as founders. Most brilliant thing ever.
And if you have a practical brain, it doesn't take a startup genius to have some common sense around that, right? Like if you're trying to raise $1 million and it takes you a year to get there, what do you do in that year in between? You suffer and you struggle and you probably make very limited progress. Where if you're getting dripped, $50,000, $100,000 a month, all of a sudden you've got money in the bank to spend and make progress, which is what everyone wants.
Right. And what they don't tell you, and I can say this from experience, sometimes if you get too much money in a bulk up front, you won't make the best decisions with it. That drip of money, even though it seems like this constraint and this pain, as long as you can bring it in while still spending most of your time focused on building the business, the scarcity drives smarter decisions. You won't blow it all on one experiment that turned out to be wrong.
I love that insight. And as an early stage founder, particularly you're a first time founder, a lot of things you're doing are the very first time you've ever done it in your whole life. And you may have some research, you may have talked to a friend, there may be some things that you can glean from people around you, but it's still an unknown. So the active test and learn, which is something that I talk about all the time, is defining a hypothesis in simple terms, like what does A look like? What does B look like? How do you get there? And then measuring that and then making that dynamic as you go syncs up really elegantly with that amounts of angel allocation that come across a period of time.
Absolutely. What I want to talk about, I want to go back to your comment of safes are sometimes fuzzy because there's two ways safes bite people. One bites the founder and the other one, I was going to say reverse bites the angel. But I want to talk about those because those get me all fired up because it's what people don't know about safes.
I love it. And let's do the Chick-fil-A drive-through story.
My Chick-fil-A drive-through. Should I admit I was in Chick-fil-A drive-through?
That's all class. I'm going to give you that. It wasn't,
okay.
It could have been a White Castle.
So here's the rub with safes if you are a founder. And most founders don't realize this until they've been a founder a few times. So the beauty of safes is you can raise money sequentially. The beauty of safes is also as your company learns more and becomes more valuable, you can change the post-money cap, valuation cap on those safes. So maybe your first safe out, you had a 5 million post-money valuation cap. Maybe 6 months later, you wanted to raise at 8 months. You wanted to raise at an $8 million post-money cap because you learned some more things and your company's a little more valuable and you don't want to take the dilution you would have taken on $5 million. And then it moves to 10 and maybe it even moves to 12 or 15. So what you've got is a thing called stacked safes. And the thing about safes on stacked safe that bite founders but are a huge benefit to angels is they're non-dilutive. So the subsequent round, so that like when there's an equity raise, those safes convert to equity. Each of those safes convert individually to equity at their post-money cap. So, I can't do math on a podcast, but the first round of safes convert and those people own a certain percentage. The second round of safes convert, those people own a different percentage. The dilution does not come from the first round of safe holders. It only comes out of the founder. So when I asked this founder, how much of your company do you own? It wasn't a matter of adding up the individual dilutions from each of the safes, because every new dilution just hit him and his team, not any previous investors. So there's that dangerous underbelly that as you stack safes as a founder, you do really lose sight of what ownership you have and don't have. And that matters both from your own motivation, but also it matters for raising a subsequent priced round. Because if an institutional investor comes in and sees you've given away accidentally 60% of your company, before they show up on your Series A round, I got to tell you something. They're not going to invest in you because they're going to say you're not properly motivated. You've given too much away and you look sort of like an amateur. So that's the fuzzy side for founders. On the flip, did you hear what I just said for angels? Like, this is amazing, right? I hear angels all the time, like they've made like 3 or 4 investments and they start bitching about safe notes. Well, it's future equity. I don't really own anything. These are sitting around for a while. I don't know if I like it. Maybe I want to do convertible notes. That's debt, right? Like maybe I want to do something different. I'm not comfortable with safes. And I'm like, these guys don't understand. Safes, they help them, right? Like, because they're non-dilutive. That founder can go on to raise, after you put your money in, they can go on to raise a few $1 million on safes. And if you bought in $100,000, I can't do math, $1 million on a $5 million post, you're going to own 20%, no matter how much they raise after that. That's crazy. That's crazy talk. It's non-dilutive. So I think angels should like them more than they do. And I think founders should be more wary than they are. I think everyone's sort of misaligned on how they feel about them.
Definitely. And to carry the math forward on that. So if you had 20% of the $5 million post money and then they raised at $15 million, that $1 million that you had would now be worth $3 million. And that would probably happen in the space of a couple of years. So as far as the future equity in the acronym, I really pause and reflect on that future equity because it is non-dilutive. Because if you invested in a Series A round, every time something else gets invested into it, you dilute every time.
Yep.
This is getting a seat around the table at a future point in time. And that's the thing that you really need to understand on the safe note of where the strength is as an investor.
Yep. And I mean, the lack of dilution is an added benefit. The strength is your founders can keep their heads down and keep building. And that's what you want a founder to be doing, because that's more valuable than gold at the early stage.
What a great way to wrap up. That's the safe note in 15 minutes. Next, we're going to tackle convertibles. If you want to understand a bit more around alternative ways to come in, convertibles are an interesting mode, and we'll cover that in episode number 7, which is our next one. But Cheryl Kellond, thank you for joining me today. This has been more of a hot take. I've loved this one.
Who has a hot take on safes? Oh my God. Let me have some more coffee.
Let's do that next time. Thank you.
Bye.
Angels Decoded, a weekly podcast for people learning the craft. Angel investing made easy. Subscribe, then decide. Angels Decoded, in cahoots with Play Money.